Assalamualaikum warahmatullahi wabarakatuh and greetings to Dr. Fauzi. This is a presentation by Group 3 Occurrence 3 about time series and cross-sectional analysis under construction sector. Introducing to our group members, which is Kau Rongkian, Adrina Badrusha binti Muhammad Tazi, which is me, Aida Badrusha binti Muhammad Razif, Farah Wahida binti Amir, and last but not least is Wong Yao Ki. First of all, it's about background of Kemudah Berhad. Kemudah Berhad is a Malaysian construction company as one of Malaysia's major infrastructure corporation. It's known for developing and implementing innovative technology. The company was incorporated on October 6, 1976 and listed on Bursa Malaysia's main board on August 10, 1992. It was initially established by Kun Yew Yin and Lin Yun Ling. The company does engineering, building, real estate development, club management, and water and highway concession. Next is about background of IJM. So IJM started with forward-thinking civil engineers. IJM was founded in 1983 when IGB Construction Sdn Berhad, Jurutama Sdn Berhad and Munajaya Sdn Berhad merged to compete with well-capitalized international competitors in the burgeoning Malaysian construction industry. IJM has won nearly 40 years of global games. It is a trusted Malaysian corporation that gives innovative solutions to business partners and customers. The company was renamed IGM Engineering and Construction Sdn Berhad in 1984. After IGB Construction Sdn Berhad, Jurutama Sdn Berhad and Munajaya Sdn Berhad have partnered to compete with foreign companies in Malaysia's booming construction industry. Next is about background of Sunway Construction Berhad. Sunway Construction Group Berhad is Malaysia's largest construction company. Sunway Construction has grown from a subcontractor to an internationally recognized full-service construction giant in 40 years. Sunway Group won Builder of the Year in 2003, 2005 and 2013 and they also have been winning a Contractor of the Year in 2019.
Thank you to Adrina. Now Aida and me will continue the presentation for time series. Firstly, I will explain liquidity ratio that include current, quick and cash ratio. Firstly, current ratio. The chart shows the company paid its short-term liabilities 1.59 times in 2019, 1.62 times in 2020 and 2.21 times in 2021. Kemudah improved performance by increasing short-term floating rate borrowing with a lower rate and longer maturity. Kemudah focused on interest rates and locked in borrowing costs with bonds and other long-term fixed rate borrowing. For quick ratio, we have seen positive progress in 3 years and the company is meeting its obligation with liquidity asset. In 2019, 1.43 times, in 2020, 1.46 times, and the highest is in 2021, 2.03 times. In 2021, Kemudah's quick and current ratio increased because the company refinanced short-term debt with long-term debt, reducing short-term borrowings by 1 billion ringgit. For cash ratio, the company had enough cash to repay 21% in 2019, 26% in 2020, and 29% in 2021 since Kemudah lowered debt and increased cash flow. Next, I will explain about activity ratio. Activity ratio consists of 3 parts, which are inventory turnover ratio, total asset turnover ratio, and average collection period in days. Cost of sales divided by inventory gives us the inventory turnover ratio. The company must restock 2.09 times in 2019, 0.91 times in 2020, and 0.87 times in 2021. In 2019, Kemudah completed their product on schedule, but in 2020 and 2021, the ratio decreased due to MCO delays. Total asset turnover ratio, Kemudah's profit per 1 ringgit is 27 cents in 2019, 20 cents in 2020 and 19 cents for 2019. This ratio is declining from 2019 to 2020 which could affect the company's stock. Gamuda earns more in 2019 due to many projects. Since the project was delayed, we could see fewer payments made in 2020 and 2021. Average collection period. The longest number of days that Gamuda need to collect their account receivable is in 2020, which is 379 days. This is due to the MCO. Company could not resume their project, so they could not collect the payment from the debtor. The shortest period was in 2019, which is 284 days. In 2021, Gamuda average collection period days was 284 days, meaning that it is higher than 2019 but lesser than 2020. I will continue with leverage ratio. Leverage ratio consists of debt to asset ratio, debt to equity ratio, and time interest and ratio. Firstly, we will talk about debt to asset ratio. As the year passed, debt to asset ratio for Gamuda Berhad is declining. It shows a good sign since the asset that have been financed from debt is getting lower from year to year. Next is debt to equity ratio. From 2019 to 2020, the ratio rise by 0.04, which is from 1.08 to 1.12, and from 2020 to 2021, the ratio fall by 15 basis points, which is from 1.12 to 0.98. Next is time interest ratio. From 2019 to 2020, there is a decline in the ratio by 6.8, while from 2020 to 2021, the ratio increased by 3.78.
Hi, my name is Aida Patricia. So today I will continue the presentation to explain about the profitability ratio for Gamuda in 2019, 2020 and 2021. So profitability ratio consists of gross profit margin, operating profit margin, net profit margin, earnings per share, return on asset and return on equity. So this is the graph for profitability ratio. So for explanation part, as we all know, the COVID-19 pandemic stopped a lot of workflows in every industry, included construction. During the MCO, every construction work stopped during 2020. Fortunately, movement restriction was relaxed after a while, and the operation had kept their workflow on track. Therefore, we could see the net profit margin is the lowest in 2020. For operating profit margin, 2020 is also slightly lower than 2019 and 2021 due to MCO. For earnings per share, we could see a drastically decrease around 50% in 2020 compared to 2019. According to the company, this is due to the restricted movement by the COVID-19 pandemic, which caused the business to stop operating for a while, and this caused a 26% decrease in annual core earnings compared to 2019. However, it slowly recovered at the end of fiscal year as the productivity levels were almost back to the pre-MCO levels. For ROA and ROE, it still has the lowest value in 2020 among 3 years due to the COVID-19 pandemic, but the company is still performing good overall according to the percentage given. Okay, let's continue with market ratio. Market ratio consists of price earnings ratio and market to book ratio. This is the data for Gamuda from 2019 until 2021. So from the data and chart presented, we can clearly see that the price earnings ratio in 2020 is almost double compared to 2019 and 2021. Generally, a higher price earning ratio can be a bad in terms of performance. It can also to be blamed that the COVID-19 pandemic came unexpectedly, forcing the industry to stop working, considering the sake of healthiness of employees. A lot of construction is stopped and the net profit will decrease drastically and it couldn't be avoided. Also, a higher price earning ratio also indicate that the share price of Gamuda was overvalued and indicate its poor performance overall at the same time. It would be better be said that investors here were not well attracted to invest in Gamuda, considering the value of price-earning ratio in 2020. In terms of market-to-book ratio, Gamuda was performing normally as the values were both around 1. Therefore, uh, there was nothing to worry about this company despite facing the challenges by COVID-19 pandemic. For viewpoint analysis, this is the data for 2019. It was 9.05% and it was decreased in 2020 to 4.47% and it slightly increased to 6.52% in 2021. Gamuda Berhad's return on total asset was the highest in 2019 compared to the other years since it had the largest net profit margin in 2019 compared to 2020 and 2021 due to the lower operating expenses and the effect of COVID-19, which is almost all the construction projects were forced to stop due to the MCO. Besides, Gamuda Berhad's financial leverage multiplier has remained relatively stable from 2019 to 2021 at 2.13, 2.17, and 2.01 in 2020 and 2019, 2020, and 2021 respectively. This demonstrates that Gamuda Berhad had been reducing its use on debt to improve business processes from 2019 to 2020 because the MCO in 2020 affected construction intensively through the pause of the construction activities. However, its dependency on debt increases in 2021 due to the better condition of MCO in 2021. By multiplying ROA by the financial leverage multiplier, we can get the Gamuda Berhad's return on equity, which is 9.05%, 4.47%, and 6.52% in 2019, 2020, and 2021 respectively. That's all from me. Thank you.
Good day everyone. Now Rongchen and me Yao Qi will present about the cross-sectional analysis. This is the table of liquidity ratio. You can see that Sunway has the highest current ratio, quick ratio, and also the cash ratio. For next slide, I will explain to you about the chart of liquidity ratio. From the data and chart presented above, we could see Sunway has the lowest current and quick ratio among the three companies. It was due to the Sunway invested in HL Sunway JV Private Limited Company to acquire the land in Singapore for ICPH, and many Sunway clients were facing cash flow issues due to the COVID-19 pandemic. In terms of cash ratio, Sunway also has the lowest value compared to Gamuda and IJM. It is because the capital expenditure is higher in 2021 due to the plant and machinery spent for their ICPH plant. And also Sunway also needed to repay its loan and dividends in terms of financing. However, it might be dangerous to both companies, especially Sunway, since the cash ratio is below 1 and it indicated that they were not able to settle their short-term debt using cash. This slide shows about the table of activity ratio. You can see that Sunway has the highest inventory turnover ratio and also the total asset turnover ratio. However, Gamuda has the highest average collection period. For the activity ratio, we can see that Sunway has the highest inventory turnover ratio. This shows that Sunway has the strongest sales among the three companies. because Sunway has excellent efficiency in managing its stock of goods sold. As seen in the data above, three of the companies have an inventory turnover ratio above 0.5, which means they sold more than half of their inventory in year 2021. For the total asset turnover, Sunway also has the highest ratio, which is 0.93. This indicates Sunway is the most efficient at generating income and revenue from its assets. However, Gamuda with 0.19 and IJM with 0.25 have higher total asset than revenue, causing the ratio to be smaller. For the average collection period, as shown in data and chart above, Sunway has the shorter periods. This indicates that Sunway has higher liquidity among the three companies, and Sunway also has the effective business credit collection policies. Another company, which is Gamuda with 345 days and IJM with 146 days, indicates their company does not collect accounts relatively quickly. This table shows us about the leverage ratio of Gamuda, IJM, and also Sunway. You can see that Gamuda and IJM has the same debt to asset ratio, and the IJM has the highest debt to equity ratio. For the time interest earn ratio, the Gamuda is the highest. Moreover, for the leverage ratio, as we can see, all three companies maintain a healthy value regarding the debt to asset ratio. From this, we did not have to worry for the company in which they were unable to pay off their short-term or long-term debt as their assets were sufficient. In terms of debt-to-equity ratio, IGM is quite dangerous, but not the other two. In this context, the IGM team management announced that they will continue to monitor and assess its debt position to maintain IGM at a healthy gearing level. Alongside with the time interest earn ratio, we could see a higher value in Gamuda, but a lower value in IGM and Sunway. Although a high value in Gamuda indicates that it was performing well, a low value does not mean to be bad. From here we can see that Gamuda was focusing on a stable performance, but IJM and Sunway were more likely to grow their business.
So here is the table for the final calculation for the profitability ratio in cross-sectional series. And we can see that despite having the lowest EPS, which is earning per share, but some are actually having the highest return of assets and return of equity. So let us proceed to the next slide. So here's the graph presented. Now, if we look at the profit margin, we can see that Gamuda was actually doing fine, as after the COVID-19 pandemic, it successfully spiked its profit. Now, why did Sunway actually having the lowest overall profit margin? It is because Sunway was focusing more on its company growth rather than a steady performance and stable performance, right? And therefore, their profit was low and their cash flow actually tend to be an outflow. And in terms of earning per share, which is EPS, we could see a higher value on Gamuda and the lowest in Sunway. And we could bet that Gamuda's EPS was more attractive to the investor outside as it was able to bring more profit to them. Now, we could see a lower EPS in Sunway. And like I mentioned before, because Sunway was actually focusing on expanding and growing its business by financing their cash into relevant things, and thus their earnings per share was lower in the particular year, which is 2021. And that's all for the profitability ratio, and let us proceed to the market ratio. So here's the table for the final calculation for the market ratios. Gamuda was the lowest, and the Sunway was the highest for the price earning ratio. And for market to book ratio, the lowest was IJM and the highest was Sunway with a 2.88 times in terms of market to book ratio, and which was way more higher than the other two companies. And I will explain them further in the next slide. See from the graph presented, despite a higher market to book ratio, Sunway was the highest price earning ratio, right, compared to the Gamuda and IJM. And as mentioned before, Sunway focused their cash flow and in their initiatives on investing and therefore having a higher debt in the corresponding year, which is 2021. Sunway had a lower cash ratio and as the outflow cash was taken into investment. And however, it might spike the investor confidence in another way, despite having a 2.88 of market to book ratio, as Sunway might be focusing on growing and expanding their company. And additionally, the way that Sunway behave might sound interesting to value investors outside. value investor, since this type of investor focus more on a growing company instead of a company which is having a constant performance like Gamuda. And for Gamuda and IJM, in which they both having the market to book ratio below 1, they were indeed indicating a better and safer to be an investment for most investors, as they were enough to liquidate their assets to pay off their debts. And therefore, it was less risky to invest in Gamuda and IJM compared to Sunway. So here is the DuPont analysis calculator for three corresponding company. The Gamuda is 6.52%, the IJM is 3.55%, and for Sunway is 16.19%. So here's the bar chart for each companies. With a DuPont analysis, investors and analysts can dig into what drives changes in the ROE, return as equity, or why an ROE is considered high or low. And also, DuPont analysis can help to determine whether the company is profit or not, the usage of their assets or debts that is driving the ROE. So using the DuPont formula, Sunway had the highest return on total assets, which is 3.24% compared with Gamuda and IJM. And Sunway had the lowest amount of total assets, which is 8% of the total asset for IJM and 10% of total assets of Gamuda Berhad in terms of ratio. And although Gamuda has the highest net profit margin, but the effect to return on total assets was actually low. Now, in terms of financial leverage multiplier, it was 2.01 for Gamuda, 1.93 for IJM, and 2.6 for Sunway, respectively. Now, this demonstrates that IJM had the lowest amount of money the company has borrowed to finance the purchase of assets, and the low financial leverage multiplier actually contributed to its good performance. However, the result also shows that Sunway had the highest amount of money the company has borrowed to finance the purchase of assets. Now, it will cause the return on equity, which is ROE, to be higher than the others. So by multiplying ROA by the financial leverage multiplier, we can get a return on equity for these three companies, which is 6.52%, 3.55%, and 16.19% for Gamuda, IJM, and Sunway, respectively. And that's all for the cross-sectional analysis. Thank you, and we will go to the conclusion.
As the conclusion, in the 3 years from 2019 to 2021, Gamuda Berhad's net profit is steadily declining. The company's return on equity will also be affected by the fall in net profit. The slowdown in the building industry a few years ago accelerated as a result of COVID-19 outbreak. Gamuda Berhad has the potential to be a fundamentally good antidote to the COVID-19 pandemic since its financial results have started to rebound. Long-term investors should look into Gamuda Berhad because of the company's excellent financial position and SOPs that allow it to resume development on all of its existing projects, while also making new infrastructural projects available. Gamuda Berhad has undertaken numerous projects such as the MRT and the Smart Tunnel. Last but not least is the recommendations for the boards of directors of Gamuda Berhad include creating new board committees such as the Risk Management Committee to keep the company running efficiently and mitigate its most important risks. A 7-step risk management strategy can be used to identify, mitigate, and assess operational risk. It supports a wide range of features and is capable of reducing significant hazards at the same time. An individual's conflict of interest are reduced when he or she divides their duties. First and foremost is to simplifying corporate operation. Next is to instill in employees a strong sense of ethical principles and values. Next is to avoid human mistake, make certain that each individual is assigned the correct and compatible task within their capacity and skills. Next is to keep a close eye on the business performance hazards. In order for the board of directors to make a smart choice, the risk manager should implement the 6th step of regularly assessing the risk. The 7th phase entails taking stock of what has been accomplished so far and applying what has been learned. Gamuda Berhad can be more prepared to deal with similar risks in the future by reflecting on the company's past performance and hazards and learning from those experiences. That is the end for our presentation, and this is the resources or references that we use for our research to complete the assignment. That's all from us. Thank you.